All right, hey there, trader. Sam here from TradeDevils-Indicators. Oh, I've got a bit of a training here. I guess we'll call it that way, training, idea generator. Oh, maybe just some new ideas with regards to how you're interpreting market structure or smart money concepts here, and maybe some ideas that will help you. It's something I've been testing over the last couple of weeks here, and I think once we get into some real examples here, I think you see some benefit here. Well, of course, we can't talk about market structure without having a few line drawings here, right? So this is just to be clear. Okay, right. We've all seen this 1,000 times, right? So we get higher high, higher low, higher high, higher low. So this defines a trend, right? So thus the market structure is bullish, lower low, lower high, lower, right? So again, seen it 1,000 times. Now, when market structures and when people are initially kind of getting their head around it and going, okay, right, there's a methodology here and there's a technique and there are entry techniques and locations, etc. Well, often it's taught in a way that I think limits a little bit, and my goal here is maybe open up your mind a little bit in terms of how you might interpret some of the bullish bearish order flow. So this being right, so we confirm here. Here's the first break, higher high. Now this we really confirm it here again. Oh, there's no right answer, right? Some people one break is enough for a trend change. Others two. I think this is potential, right? We confirm it here. Now the thinking is often entirely focused on what's happening in this leg, right? So as we come up here, and then we start the retracement here, right? That we know, right, with the benefit of this you wouldn't know at that time, right here. But we see this. So as the market is coming down here, all the focus tends to be on this swing. Oh, what's in here? Well, okay, ideally, right, the perfect scenario would be we'd come down to the origin of the move here, and as we refine, we're down to the 1 minute or the 15-second chart. You're coming down here to the last little order block here, the origin of the move. So this would be the area where, oh, there's likely to be some demand down here. Now, it's often, and people use it differently, right? You might think of this as an order block. We use that language a little bit differently because we define an order block differently in our software. So we would call this a demand zone. It's just that. It's a potential demand zone. Right, now down here, refined all the way down to the last little pivot, the origin of the move. And the thinking being that, oh, well, if we come down here, right, there's likely to be demand here. This is the low that did its job, right? It did its job that gave us the break of structure. So this is the strong low because it did its job. It broke structure here, this being the weak high, right? And that thinking and that theory carries on until we get a change and we break structure going the other direction. So the thought being, oh, okay, well, if the market, as the market is dealing with everything here, well, commonly we would think of it this way. We're going to say, okay, well, if it's coming down here, well, let's look for our old friend Al, right? Algo would be in here. Our measured move algo would come down here and we'd say, okay, well, this swing is retracing. I've come to the golden zone. Perfect, right? So then this is the entry that I want. Well, that's part of it. But often, right, if you're down here and you're thinking, oh, okay, well, I know that that's a candidate here, but I'm trading market structure, so I want to wait until we come down here to this order block here. I want to get in at the lowest spot with the least amount of risk and the highest risk reward. And again, that's often how this is taught. Well, what I want you to try and reconsider is thinking of this entire move down here as equal, giving it equal priority to what's happening here. Now, as we're coming down, of course, there's often, right, you're looking in here, do we have an imbalance? Was there a fair value gap here or multiple fair value gaps or a little pivot here, a little consolidation? It's all focused here. But because, of course, we know time being fractal, that if we, so for example, if we were looking at a 15-minute chart right here, which is what we're about to look at, well, I'd have 15 candles here that I could be tracing out this retracement lower here, and it's certainly valid as we acknowledge that money had to be committed to create the retracement down here before money is committed to bring it back higher. Well, as we're coming back down, while of course this is I'll put it back on. Of course, this is important here, right? We don't want to ignore the fact that there's a potential retrace here via our measured move. So if we're looking down here, well, wait a minute, I got a little conflict here because wait, I thought I was waiting down here for the demand zone here. I'm using the wrong language. For the demand zone down here. Whoa. So am I buying it here and just leaving this down here? Okay, well that's valid, right? No, maybe you're reacting to, maybe there's a fair value gap here, and that would sweeten this, of course, all the more, right? You could take advantage of that imbalance in conjunction with where we know an algo is going to fire. Well, I want you to think beyond that a little bit, because if again, as we consider a 15-minute chart here, because it's fractal, we've got 15 bars here driving this down. So if you are going from a 1 minute to a 15 and then 15 to 1 and back and forth, as we look at this on a 15-minute, we can consider all of this as the demand zone here. Let me get that out of here. So I would have you reconsider that to where all of this can be considered a demand zone. It's the swing down before we swing up, right? If you want to think of it that way, keep it very simple. The last swing down. Now, without going into a whole dissertation about how market makers and BIFs, I call them, banks, institutions, and hedge funds, right? So, and how they manipulate price and move the market. Excuse me. It doesn't. It doesn't really matter, right? The point is, can we identify opportunity here based on the idea that we know if the market is going higher, likely there was some manipulation going on from the BIFs to bring it down here so they can buy at a better price, right? That's ultimately what it comes down to, right? We can get bears getting enthusiastic as we're retracing here and then accumulate all of those shorts here and then rip it higher. So as we come back down here, this entire leg here can be considered, it's in smart money concept theory, right? This would be considered bullish order flow because it's the accumulation here before we go higher. And the same thing here. This would be bullish order flow here before we go higher. It seems counterintuitive since it's going down. But the thought being that as the market is going down, the BIFs are accumulating here before they send it higher. Now, if they're accumulating shorts here before they send it higher, what they're going to want to do is bring it back down into this location so they can mitigate those shorts, because ultimately their intention is to take it higher. So that's where the idea, right, and again, I'm simplifying here, the idea of mitigation comes from, right, is in terms of how the market makers and the BIFs are working their books, right? So accumulate shorts here, swing it up here. Now, they will often be long and short at the same time, right? In fact, that they are, right? Long and short at the same time. So they will have accumulated shorts here and then longs as well. So when they bring it back down here, they want to get out of those shorts at break even or a profit and then let it rip with their longs. So what we want to consider here is that this move down here and this move down here, these can all be considered, if it's easier for you to think of it, it's just as a larger demand zone. I'm going to say it that way, right? So the whole move down can be considered demand. Now, the ideal way to look at that, right, in a perfect scenario, we'd have a PDA, right? So we'd have a premium and a discount zone. So if we cut that here, if I get that right up on the high, if we cut this in half, right, we get premium and discount of this retracement leg here. So and I've idealized it here. So the perfect scenario would be a retracement that comes right down to the discount or the equilibrium here, the 50% of this swing lower, where we bump into a golden zone. Right now, that's again idealized. You're not. That's it happens, right? But we don't want to wait just for that to get the perfect 50 at the golden zone. Although you will see it more times than you'll believe, right? How consistent that is. But again, the focus is not so much this leg, right? We don't want to ignore a golden zone retracing this swing low to this swing high. We don't want to ignore it, but I want you to put your focus over here. So as we're retracing down here, can we get to the first question is, are we mitigating? Can we get mitigated into the discount? That would be ideal, and then you've got better risk reward, right? Because your stop would likely be towards the pivot. Depends on the range here, how much distance that is. But that, again, I'm going to speak in just idealized terms. If we come down here to the 50, tag the 50, if that happened to be a golden zone, right, just sweetens it. But let's take this part out of it and just get this, and we'll just focus on. There we go. I want you out of here. All right, so let's delete you if I can get it off. There we go. All right, so I want the focus now not so much on the swing up, but rather the swing down, because then this process repeats. So we would look here, and then this would be potentially our next. Jesus, Ninja's not the best for this. TradingView is actually much better for this kind of graphic work. Jeez, I can't even get that off. Right. So the whole process would start again. Again, easier to do on TradingView. We'd come down here and then go here. Right. So this would be yet again another demand zone here. It's the same concept, right? Can we come down here and mitigate here the shorts that were accumulated here before going up? Can we come back down and mitigate that, do it at a discount before we continue higher? Right, and then of course the same thing over here. So if we're coming, the focus being, well, let's just do it this way. Let's do this leg here. So this is the leg. So as we come back towards this direction here, right, which is just part and parcel of how we interpret market structure, that we get a break of structure, we anticipate a retrace. Well, the retrace here is to mitigate the order flow, in this case, the bearish order flow that is in this leg higher before going lower. So again, I know it seems counterintuitive to call it bullish and bearish order flow when it's going the opposite direction, but this would be the bearish order flow, the accumulation of longs before it's driven lower, and then retrace to mitigate those longs, right? So then it can carry on in its path lower, right? That's the theory, right? So with that being the theory, maybe hopefully I didn't confuse you there, but when I take it to the charts, hopefully that's going to make things a little bit easier. So let me get all this stuff off here. And how are we doing on time? Let's go over to a chart. Okay, so as I always do, I just use the last, well, this is what I got here, 2 weeks of data, just right up until Friday's close. Now I'm recording this on Saturday the 14th, so markets are of course closed. Okay, so when we look at a 15-minute chart here, one, we know this is where the institutions live, right? This is where this is their main hunting ground. So when you look at a 15-minute chart like this, often it's a good idea to do it. Just strip it bare and look at it. And what do you see here? Because institutions, banks, institutions, hedge funds, or BIFs, they leave footprints, right? Because only institutions, what's the best way to do it? Here, I use the arrow. Only institutions can do this, right? Where we have this kind of massive movement here, right? Retail can't do that. Only institutions can do this, right? Can move this, right? Now that's news related, right? But again, right, that's institutions doing that. And it's just over and over again. You can see their footsteps, right? I mean, that kind of massive move on massive volume with no one on the other side, that's entirely institutions, right? And then we see it coming down, right? Then here they're unloading it, right? Big footprints that they leave all over the chart. If you just step back and look at them, you can see exactly where they got in the market, right? Where they got involved. Not hard to spot. Okay, now let me clear that up and see if we can make some sense of this. Okay, that's great, Sam. How does this help me? Well, first thing I'm going to do is I'm going to add our market structure indicator. I'm going to turn it on. I've got nothing on but the market structure, because all we're going to do is just focus on as I was just described them, the counter trend swings, which is where we're getting the opportunity to participate based on their original objective of where they want to move the market. I probably didn't say that clearly, but let me see if we can start over here on the right side of the market. Okay, so what we want to focus on, let me open this up a little bit, and then I was trying to get the whole 2 weeks on the screen, but there we go. All right, what we want to focus on is just like we would with an order block right here. Now, of course, it's different on a 15-minute. We want to look for the upswings, right? Just like you would if you were trying to identify the order block or the demand zone block or bar. Rather than just the bar, we want to look at the entire swing structure there. So what we want to look at, so for example, here, we want to look at this downswing that led to the upswing here that broke that structure before we head down. So if we were going to mark that off, we would do it this way. So here's the high, right, that was broken. Here's the swing down, and then here's the swing up. So all of this, at this moment in time, we have all of this unmitigated. Right, now we come down here. Now let's start to draw it over. Now we come up here and we tap it here. Mitigated? No. All right, so this, as we go into the remainder of the week, this sits unmitigated. Well, lo and behold, look look where we finally mitigate this. If I bring it all the way over to the end of the week, it's not, I'm trying to get that low there. It's not until the very end of the week that this gets mitigated, right? So all of this activity down here, right, has left this unmitigated pocket up here, this little down before the up, which is left untouched, right? Here's the edge of it. Can't get there, little pick. Now we fully mitigate. Right, so conceptually, hopefully that you're starting to see that, right? This is very powerful if you do it yourself, right? So I'm going to leave this one here. Okay, so let's just keep going now. I know this is a little tedious the first time I do it, right? And as we go to other charts here, it'll go a little faster, but I think there's value, and I would encourage you to do the same thing. There's value in kind of walking you through this. Again, this will be the most tedious as I do it for you in real time, but as I would strongly recommend that you do this yourself. Okay, so now what we're looking for is the last upswing before we break structure. Well, here's the break of structure right here. So it's the swing up before we swing down, right? So if I open that up, maybe that makes it easier to see. Right, here's the break of structure. So I want to look at what happened, the upswing here before it's broken. So I think it's just as well to do it this way. So if I take this entire upswing here and then I start to bring it across. Right, so break of structure. Now we're coming all the way back up here. This now is fully mitigated. So if I were to use this as a handy little tool in our toolbar where I can get a perfect channel, straight lines. Right, so premium discount. Here's the swing up before we broke structure. Now we get another little break of structure here, but we'll come back to that. But as we look here, right, so now you can see here we get into the premium. We go right up to the edge of it before we start coming back down, and we are fully mitigated. So as now the trend can continue down. Well, now we could kind of here, let's get that off of there. This is probably easier to work with. Well, you could really do the same thing here, right? And say all of this is the up before we break. But I think we can refine this a little bit better since that's really already been used. Let's do it this way. Here's the last upswing before we go down. Right? So now typically if we were thinking about this in just typical order block, right, or training, or how people are often teaching that, right, it would be the last little up candle here before we go up, the last little upswing. Or what all I'm suggesting to you is that we can use the entire upswing here and then look to see if that will be mitigated. So if I do the same thing here, let's bring it. I think this is this is not easy. Ninja's not the best for this. If I bring this over, okay, here's the last upswing. So now we come up here. Now if I do it, I'll give you the 50 on it. All right, so that's ideal, right? Where we can get into the discount, premium discount. Well, here we come right up to the 50, right, where we are getting this mitigation here. So the upswing before we go down. So there's more down here, but as we come all the way back up to it, we ping the 50, and then we come back down. So this is mitigated here. Let's take this one out of there and bring this one over here, and we'll just call it mitigated there. Well, we've got these as well down here. Let's see. So this is a good example right here. I'm not going to get every single one of them here, but here's the last upswing before we head down. Right, down. Now we come up. Now we come all the way back down. We don't get into the 50, but we get just enough to, you'd call that, it looks like there's a little fair value gap in there as well. Yep, there is. If I draw this in here, there's a little fair value gap right there. Looks like that may have been part of it. So we come back down here and tap into this. We don't get deep into it. We don't actually make the premium. Maybe you missed that one. Maybe that was just not good enough. Here's another one here. So as I keep going here, but just so you recognize, okay, they're coming back in here to mitigate it here. Well, where's the next break of structure here? Here's the market structure shift here, meaning this downswing we want to pay attention to. Let me pull. It's so hard to do this on Ninja. Okay, so let's come back here. So here's the break of structure. So here's the downswing. Right, here's the swing down before we break structure. We're coming back into this. Now here we can look at it this way. Here, I know this is tedious to go through it this way. right? But here, right? So okay, you look at that and you go, oh, fuck, all right. Well, how much was there? Just $1,000, just 80 ticks. Remember, it's a 15-minute chart. Now we're going to take this down to the smaller time frames, but conceptually, I think this is a better place to do it because there can often be too many if we go down to a 1 minute, 2 minute, which we're going to do. But just so you get the theory here, oh, wow, how nice, right? And then do I have imbalance here? Yeah, I do. All right, so it looks like there's a fair value gap in here as well. I could turn these on here, but I'm just trying to show you that these are in here as well. So we got a little imbalance, ping, 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 right? Now we get into the 50. Now we're coming back down. Let's keep going here. Again, I'm not going to hit every single one of them here. So here's the break of structure. So here's the last down before we go up. Now here's one that fails. All right, so here let's see, where's my break here? So this would be the low. So this would be the down before we go up and break the structure. So if I bring this over, right, now we come right into this. Now this is news, obviously, right? So this, what was that? Friday, employment, Fed, shit, I can't remember, right? So this is news driven, right? So it's typical, right? Straight down, then all of it recouped and goes straight up, right? This is just welcome to trading. Also, not a bad example, except we don't get a break of structure here because the break of structure came before the news, right? Amazingly, there's not a break of structure there. Oh, pardon me, there is one right here. Right here, so we get a retrace here. So this, oh, well, then we get the close of the end of the week. But this would have been sitting there, right? Going into the next week, right now it's 10 in the morning. It's not bad. Right, for a possible trade, what's there? 88 ticks. Now, again, are you going to get swing low to swing high? Right, probably not. Right, but it just again the identification, like, hey, okay, well here's an unmitigated zone here. I want to pay attention to it. Okay, well I don't get a deep retracement here. In fact, I keep going higher. All right, let me just see if I can finish this up here because I think you're getting the idea. This, of course, is the overnight here. This is going to be Asia. Oh, I think. Is there enough here? Yeah, here's a good example, so I don't bore you to death here with all of these, right? But we'll get the gist of it here. So this is Asia session, Asian session. But so this is a beautiful example, right? So we got two things here. Here's the break of structure. So the last swing's higher before we break, right? This remains unmitigated. Right, this swing up before we come down, unmitigated. So it's sitting here waiting, right? Don't get that. Next one. Here's the swing up before we break structure, right? So this, I'm actually just going to use this one, right, just to make it easy, right? So here's the break. Here's the swing higher before we go lower, right? Well, look what we do over here, right, on Friday, right? And if I put my little 50% on that, and we do it this way, right up to that pivot. You see this little tweezer top here, because just enough to get into the discount, or pardon me, to get into the premium. Right now, obviously we have a massive fair value gap here, right? We come back up to it, but just heads up, right? That's what's happening there. And you see it again here on the, going into the close. Now you're gonna be trading here, maybe not. Same thing. We come in, mitigated, right? It gets over the 50% of that of this upswing before we head down, mitigated. So coming into the week, this is mitigated. Oh, let's see. I think that covers most of it. Let me do this. All right. So let's add some flavor to it before I wrap this one up here. So now let's go. We've got these on. Now let's put our order blocks on, and let's put our fair value gaps on, and see how some of this lines up. You see, right, that often you'll get an overlap conceptually, and thus we get confluence, right? So here we come. Well, here we looked at this one here. This doesn't get tapped until we get all the way over here. We start to look at some of these. Okay, well here's the swing up. Again, I know it's hindsight. I'm just trying to kind of draw your eye to these things. So as we come up into this one here, which we come into it right into the 50, we're on the edge of, if I bring this over, we're on the edge of that fair value gap here, right, which is right here, right? We come literally wick the top of it before we come down into this one. This one actually we break some of the lows here before we come back up here. Now here I am again in this section here. That's the news, leaves behind this massive fair value gap here, right, that gets filled in. right? It actually creates an order block on the other side. Now here, oh, we're going into the overnight here. This is where that gets mitigated up here. Oh, fair value gap here, imbalance, right? Remember when we first looked at this and I had everything turned off? We were just looking at the big explosive bar, the displacements, right? That the BIFs create. Well, here's a big displacement, right? We're leaving all that behind. Well, here we come in and we tap it. We don't quite make 50, but we get it and we tap it. Right, so we mitigate this imbalance here. Same thing here, mitigate, right? We swing down below. That's probably the Asian low before that gets taken. Now we're back over to this one, which I just drew out as a great example. Well, notice here, in addition to being right at the 50% here, well, we've got these fair value gaps here. That's right up to the edge of this imbalance here. There's another imbalance here, and then this is what we would call an order block here. So this up at the top remains unmitigated. This unmitigated here, this last little swing high. Well, there's an example of where you're looking for the absolute order block high, right? And so you miss it, right? You don't get filled here. But if you were doing it this way, which is what I'm suggesting, right? The last upswing, right? You're getting it perfectly. All right, let me stop here so these videos don't get too long. But just I wanted to kind of put that in your head, and then when we go down to some shorter time frames, see how you might use this for more of a day trading approach. Although certainly you can use this for day trading, but these would be some bigger stops. Maybe this is something you're using if you're working on a 15-minute. Maybe you're working with some options on the index. Maybe you're working with a SPY or QQQ or something like that. So okay, with that, let me pause here, and then I'll come back at it. We'll look at some very short time frames. Okay.